The UK property market is having what some are calling a meltdown moment, and the numbers coming through right now are genuinely alarming. We're not talking about a gentle slowdown or a minor correction. We're watching home valuations crash while deals that looked rock solid just weeks ago are falling apart at the final hurdle. Buyers who thought they were about to get the keys to their dream home are being left empty-handed, and sellers who were counting on completion are watching everything crumble right before their eyes. This isn't the kind of gradual market shift that economists love to predict. This is sudden, this is dramatic, and this is happening right now across the country. If you own property, if you're trying to buy, or if you're just trying to understand where the economy is actually heading, you need to hear what's unfolding. Hit that like button and subscribe to Property Reporter so you never miss the latest updates on the UK property market, the economy, and everything affecting housing across the nation. The scale of what's happening is staggering when you look at the actual data. Property valuations are being slashed at rates we haven't seen since the financial crisis, with some homes losing tens of thousands of pounds in estimated value almost overnight. Estate agents are reporting that properties which were valued just a month ago are now coming back with figures that are 15, 20, sometimes even 30% lower. These aren't properties in declining areas or homes with major structural issues. These are ordinary family homes in what were considered stable markets. The speed of this decline is catching everyone off guard because it's not following the usual patterns. Normally, you'd see gradual adjustments as the market responds to economic conditions, but what we're witnessing is more like a sudden loss of confidence that's rippling through the entire system. Buyers are pulling out of agreed purchases because their mortgage lenders are refusing to lend based on the original valuation, and when a new valuation comes back lower, the whole chain can collapse. Sellers are stuck in limbo, unable to move forward and unable to drop their price enough to attract new buyers without taking massive losses. The mortgage companies are being incredibly cautious right now, and that caution is turning into a self-fulfilling prophecy that's dragging values down even further. What makes this particularly brutal is the timing and how it's hitting people who are right at the finish line. Imagine you've found your perfect home, you've had your offer accepted, you've paid for surveys, you've arranged removals, you've given notice on your rental, and you're literally days away from completion. Then your mortgage lender sends a surveyor who comes back and says the property isn't worth what you agreed to pay. The seller won't or can't reduce the price because they need that money to complete their own purchase up the chain. Your lender won't increase the loan because their policy says they can only lend based on their valuation. Suddenly, you're stuck in the middle of a transaction that's going nowhere, and you've already spent thousands on legal fees and surveys that are now worthless. This exact scenario is playing out thousands of times across the UK right now. Solicitors are reporting unprecedented numbers of collapsed sales at the exchange stage, which is virtually unheard of because by that point everyone involved has invested so much time, money, and emotional energy that deals almost always go through. But we're in a different reality now, where even the promise of completion isn't enough to hold transactions together. The reasons behind this crash are complex, but they all tie back to the broader economic chaos that's been building for months. Interest rates have been climbing at a pace that's left many potential buyers unable to afford the mortgages they could have secured just a year ago. A typical family looking at a £300,000 property might have seen their monthly payments jump by £400 or £500 compared to what they would have paid in 2022. That's a huge chunk of income that many households simply don't have, especially when you factor in rising energy bills, higher food costs, and wages that haven't kept pace with inflation. Lenders are responding to this by tightening their criteria and being much more conservative with their valuations. They're looking at the economic uncertainty and deciding they'd rather undervalue a property than risk lending too much on an asset that might decline further. This creates a vicious cycle because when lenders consistently value properties below asking prices, it signals to the market that prices are too high, which then causes actual prices to fall, which then justifies the lender's caution. It's a feedback loop that's incredibly difficult to break once it gets started. Regional variations are telling us something important about where this crisis is hitting hardest. You might expect that London and the South East would be bearing the brunt of this, And while those areas are certainly feeling the pressure, some of the most dramatic falls are happening in areas that saw massive price increases during the pandemic. Towns and cities that became hotspots for people leaving urban areas and seeking more space are now seeing those gains evaporate. Properties in commuter towns that surged in value as remote work became normal are finding that demand has cooled considerably now that employers are calling workers back to offices. Buyers who stretched themselves to afford homes in these areas based on pandemic-era valuations are discovering that the market has moved on and left them exposed. Meanwhile, some inner-city areas that saw people fleeing during lockdowns are showing more stability because they're attracting a new wave of buyers who want to be close to work and amenities again. The geography of this crash isn't uniform, which means some homeowners are being hit much harder than others based purely on where they happen to own property. It's creating a postcode lottery where your financial future depends significantly on which side of an arbitrary boundary you bought your home. The human cost of all this goes way beyond spreadsheets and statistics. Real families are having their lives turned upside down by these collapsing deals. There's the couple who sold their starter home to move somewhere bigger for their growing family, only to have their purchase fall through, and now they're facing homelessness because their buyer has already completed. There's the elderly homeowner who was downsizing to release equity for retirement and care costs, but can't find a buyer willing to meet even the reduced valuation. There's the first-time buyer who saved for years to scrape together a deposit, only to watch property prices fall but still can't buy because lenders won't approve their mortgage due to economic uncertainty. These aren't abstract market forces, these are people's lives being fundamentally disrupted through no fault of their own. The emotional toll is immense because buying or selling a home is already one of the most stressful experiences most people go through, and when deals collapse at the last minute, that stress multiplies exponentially. Mental health professionals are reporting increased cases of anxiety and depression linked directly to housing market stress, and it's not hard to understand why when your entire future can be derailed by a valuation that comes in a few £1,000s too low. Industry experts are now debating what comes next and whether this is a temporary shock or the beginning of a longer downturn. Some economists argue that we're simply seeing a necessary correction after years of artificially low interest rates inflated property values beyond what fundamentals would support. In this view, prices got too high. They're now returning to more sustainable levels, and while that's painful for current owners, it's actually healthy for the market long term. Other analysts are much more pessimistic, warning that we could be entering a prolonged period of falling prices that will leave many homeowners in negative equity and freeze the market completely. They point to the combination of high interest rates, weak economic growth, and political uncertainty as a toxic mix that could suppress property values for years. The truth is probably somewhere in the middle, but predicting exactly where this lands is almost impossible right now because there are so many variables at play. What happens with inflation? What the Bank of England does with interest rates? How the government responds with policy interventions? What happens in the global economy? All of these factors will shape whether we see a quick stabilisation or a deeper crisis. What's certain is that the old assumptions about property being a safe investment that always increases in value are being seriously challenged right now. Looking at the wider economic picture helps explain why property is taking such a beating. The UK economy is struggling with multiple pressures simultaneously. Inflation remains stubbornly high despite interest rate increases that were supposed to bring it under control. Wage growth isn't keeping up, which means real incomes are falling for millions of workers. Business confidence is low, which is leading to reduced investment and hiring. Consumer spending is down because people are worried about the future and trying to save rather than spend. Government debt is at levels that limit what can be done to stimulate the economy. All of this creates an environment where big purchases like property become much less attractive and much harder to finance. When people are worried about keeping their jobs and paying their bills, committing to a 30-year mortgage feels incredibly risky. When businesses are uncertain about the future, they're less likely to relocate or expand, which reduces demand for commercial property and indirectly affects residential markets too. The property market doesn't exist in isolation. It's deeply connected to everything else happening in the economy. And right now, almost all of those connections are pulling in a negative direction. The mortgage market itself is going through a transformation that's making all of this worse. We've gone from an era of ultra-cheap money where you could T a mortgage for under 2% to a world where 5 or 6% is becoming normal. For someone borrowing £250,000, that difference means paying hundreds more every month, thousands more every year, and potentially tens of thousands more over the life of the loan. Many people who bought in the last few years on low fixed rates are now coming to the end of those deals and facing remortgaging onto rates that are more than double what they were paying. This is creating a secondary wave of pressure as existing homeowners find their housing costs suddenly jumping dramatically. Some are being forced to sell because they simply can't afford the new payments, which adds more supply to a market that already has weak demand, which pushes prices down further. The lenders themselves are being squeezed too because they're facing higher funding costs and increased regulatory pressure to ensure borrowers can actually afford their loans. This makes them more conservative with lending decisions, which reduces the pool of potential buyers, which again feeds into falling prices and collapsed deals. First-time buyers are facing an especially cruel situation right now. This group has always had it tough in the UK property market, but the current conditions are making it nearly impossible for many. You need a bigger deposit than ever because lenders want to see at least 10% and preferably 15 or 20% to get decent rates. Saving that deposit takes longer because living costs are eating up spare income. But by the time you've saved enough, prices might have fallen, which sounds good, except that if lenders think the market is declining, they become even more strict about who they'll lend to. And if you do somehow get approved and find a property, you're at serious risk of having the whole thing collapse if the valuation comes in low. Some first-time buyers are actually hoping for further price falls so homes become more affordable, but they're discovering that falling prices don't automatically help them because lending criteria get tighter and mortgage costs stay high. It's a catch-22 that's locking an entire generation out of home ownership and forcing them to rent for longer, which then puts pressure on the rental market and drives rents up, which makes saving for a deposit even harder. The whole system feels designed to keep people trapped in a cycle they can't escape. Meanwhile, property investors and landlords are reassessing everything they thought they knew about the market. For years, the playbook was simple: buy property, rent it out, watch the value increase, use the equity to buy more property, repeat. That model is breaking down now because the fundamentals have changed so dramatically. Property values are falling rather than rising, which means no equity to extract. Mortgage costs have soared, which eats into rental yields. Tax changes introduced in recent years have made buy to let less profitable. Regulations around energy efficiency and property standards require expensive upgrades. Many landlords are concluding that the hassle and risk are no longer worth it and are selling up, which adds yet more supply to an already oversupplied market. This might eventually benefit renters and first-time buyers if it leads to lower prices, but in the short term, it's contributing to market instability and deal collapses. Large institutional investors who bought heavily into UK residential prop, RTI, are also pulling back, with some foreign funds selling entire portfolios because they don't see the returns justifying the risk anymore. When even professional investors with deep pockets and long-time horizons are retreating, it sends a powerful signal about the state of the market. The role of property valuers has come under intense scrutiny during this crisis. These professionals are the ones who decide what a property is actually worth, and their assessments are now make or break for whether transactions complete. Valuers are in an incredibly difficult position because they're trying to assess value in a rapidly moving market where comparable sales data might be weeks old and therefore unreliable. If they value too high and prices continue falling, their client, the lender, gets stuck with an asset worth less than the loan, which is exactly what banks want to avoid. If they value too low, they kill deals and contribute to market panic. Most are choosing to err on the side of caution, which means conservative valuations that often come in below agreed purchase prices. This is rational from the valuer's perspective, but it's devastating for people trying to complete purchases. There's growing anger directed at valuers from buyers and sellers who feel that overly cautious assessments are creating problems that wouldn't otherwise exist. The professional bodies representing valuers defend their members by pointing out they're working with limited information in unprecedented conditions and have a duty to protect lenders from excessive risk. It's another example of how the crisis is pitting different parts of the property ecosystem against each other. Estate agents are struggling to adapt to this new reality as well. Their business model depends on transactions completing and earning commission on sales. But when deals are collapsing at record rates, their income disappears. Some agents are reporting that they are working harder than ever, marketing properties, conducting viewings, negotiating offers, only to see half or more of their agreed sales fall through before completion. This is unsustainable for smaller agencies that don't have the financial reserves to weather extended periods of low completion rates. We're already seeing consolidation in the industry as struggling agents are bought up by larger firms or simply closed down. The agents who remain are having to have difficult conversations with sellers about pricing, explaining that the valuation they got a few months ago is no longer realistic, and they need to drop their asking price significantly if they want any chance of selling. Sellers often resist this advice, hoping the market will turn around, or that they'll find a buyer willing to pay what they think it's worth. But the longer properties sit on the market unsold, the more desperate sellers become, and the lower the eventual sale price. It's a grinding war of attrition that leaves everyone exhausted and frustrated. The government's response to this crisis has been notably muted, which itself tells us something about the constraints policymakers are facing. In previous property market downturns, we've seen interventions like stamp duty holidays or help to buy schemes designed to support demand and stabilise prices. This time, the government seems reluctant to intervene in the same way, partly because the economic context is so different. Introducing stimulus when inflation is still a concern risks making that problem worse. Halting property prices when affordability is already a major issue risks locking another generation out of home ownership. The public finances are stretched, which limits what can be spent on intervention schemes. And there's a political calculation that helping property owners might not be popular when so many people can't afford to buy at all. So instead of bold action, we're seeing cautious statements about monitoring the situation and allowing the market to find its level naturally. This hands-off approach might be economically sound, but it offers no comfort to people currently trapped in collapsed deals or watching their wealth evaporate as property values fall. What's particularly unnerving is how quickly sentiment can shift in property markets, and how that shift becomes self-reinforcing. Just a couple of years ago, the narrative was all about surging demand, bidding wars, properties selling in days for over-asking price. Now the mood has completely flipped. Properties are sitting unsold for months. Sellers are dropping prices repeatedly and still not getting offers. Buyers are walking away from agreed deals without much consequence because they know they have the upper hand. This psychological shift is just as important as the economic fundamentals because property is as much about confidence as it is about bricks and mortar. When people believe prices will keep rising, they're willing to stretch financially to buy because they expect to benefit from future gains. When people believe prices will keep falling, they hold off buying because they expect to get a better deal by waiting. The problem is that everyone holding off and waiting creates the very price falls they're anticipating. Breaking this cycle of negative sentiment requires either a dramatic improvement in economic conditions or enough time passing that properties become undeniably cheap relative to long-term value. Neither of those seems likely in the immediate future. There are some voices arguing that what we're seeing isn't a crash at all, but rather a long overdue correction that will ultimately make the market healthier. UK property prices have been disconnected from earnings and economic fundamentals for years, supported by artificially low interest rates and a cultural obsession with home ownership. Prices in many areas reached levels where average workers had no hope of buying, which is neither sustainable nor desirable for a functioning economy. From this perspective, falling prices are exactly what's needed to restore some balance and create opportunities for people who've been priced out. The pain being felt by current owners is real, but it's the flip side of the gains they made during the boom years, and younger people who haven't been able to get on the ladder might finally have a chance. This more optimistic take suggests that once the dust settles and prices find a level that reflects actual affordability and economic reality, we'll have a more stable foundation for sustainable growth. It's a compelling argument, but it offers little consolation to people currently trapped in negative equity or facing financial ruin from collapsed sales. The impact on the broader economy from a property market in crisis shouldn't be underestimated, because housing is connected to so many other sectors. When property transactions fall, so does demand for everything associated with moving home. Furniture sales drop because people aren't buying new sofas for homes they haven't moved into. DIY and home improvement spending falls because why invest in renovating when you're not sure what your home is worth or whether you'll be staying? Removals companies see business dry up. Conveyancing solicitors have less work. Mortgage brokers earn less commission. Estate agents close branches. All of these ripple effects mean job losses and reduced spending across the economy, which then feeds back into reduced demand for property because people are more financially insecure. The construction sector is particularly vulnerable because house builders rely on steady sales to fund new developments, and when sales slow, they scale back building activity. This reduces the supply of new homes, which might seem like it would support prices, but actually, it just means less economic activity, fewer construction jobs, and less investment in the infrastructure that new developments bring. It's yet another negative feedback loop that's hard to escape once it gets established. Regional politics and the North-South divide are adding another layer of complexity to how this crisis plays out. London and the South East have always had higher property prices than the rest of the country, and they've historically been more insulated from downturns because of the concentration of high-paying jobs and international investment. But this time, we're seeing the capital and its surroundings taking significant hits, while some northern cities show more resilience. This partly reflects the pandemic shift, where people moved away from expensive southern cities seeking space and affordability elsewhere, and now that trend is partially reversing. It also reflects the fact that northern property markets weren't as overvalued to begin with, so there's less of a correction needed. Political tensions around levelling up and regional inequality are getting entangled with property market dynamics in complicated ways. Northern politicians are arguing their regions need continued investment to maintain momentum, while southern MPs are worried about constituents facing negative equity and collapsing deals. The government is caught trying to balance these competing interests while also managing national economic policy, and it's not clear there's any way to satisfy everyone. For anyone currently stuck in a collapsed property deal, the immediate question is what can actually be done. The options are limited, and none of them are particularly attractive. You can try to renegotiate with the seller to reduce the price to match the lower valuation, but if they're in a chain, they might not have that flexibility because they need the original amount to complete their own purchase. You can try to find extra cash to make up the difference between the valuation and the agreed price, but most buyers have already stretched themselves to save the deposit and don't have thousands more lying around. You can walk away and try to find a different property, but you'll have wasted all the money spent on surveys and legal fees, and there's no guarantee the next property won't have the same problem. You can try to challenge the valuation by providing evidence of comparable sales at higher prices, but valuers are typically pretty firm in their assessments and lenders back their judgments. Some buyers are even switching lenders in hope that a different bank's surveyor will be more generous, but this adds more delay and more cost with no certainty of a better outcome. The frustration of having no good options is driving many people to simply give up on moving altogether, which means the market seizes up even further. The legal framework around property transactions is being tested by this wave of collapsed deals. In England and Wales, we have a system where neither party is legally bound until contracts are exchanged, which typically happens quite late in the process. This means either side can walk away at almost any point without legal penalty, though they'll lose money spent on surveys and legal fees. This system is often criticised because it allows gazumping where sellers accept a higher offer after already agreeing a sale, and gazundering where buyers reduce their offer at the last minute knowing the seller is committed. In the current market, we're seeing a surge in gazundering as buyers use low valuations as leverage to force price reductions. Sellers have little choice but to accept, because if they refuse, the buyer walks and they're back to square one in a falling market where the next buyer will probably do the same thing. Scotland has a different system where offers are binding much earlier, which prevents some of these games, but creates its own issues when valuations come in low, because buyers can't easily walk away. There's renewed debate about whether England and Wales should reform their system to provide more certainty, but any change would be complex, and there's no consensus on what would actually work better. International comparisons reveal that the UK's property crisis isn't happening in complete isolation, but it does have distinctive features. Many developed economies have seen property prices fall as interest rates have risen, but the UK's combination of economic weakness, political uncertainty, and structural housing undersupply creates a unique situation. Countries like New Zealand and Australia have seen sharp corrections in their previously booming markets, but their economies are in better shape overall, which provides more confidence about eventual recovery. European markets are dealing with their own pressures from energy costs and inflation, but many have more balanced housing markets without the UK's extreme focus on home ownership. The United States has seen regional variation, with some markets cooling while others stay hot, and Americans generally have longer fixed-rate mortgages, which insulates them from payment shocks when rates rise. None of this makes UK homeowners feel any better about their situation, but it does provide context that this is part of a global adjustment to the end of cheap money, even if Britain is experiencing it in particularly acute form. Climate considerations are starting to intersect with property valuations in ways that are adding another dimension to the crisis. Properties with poor energy efficiency ratings are becoming harder to sell and harder to mortgage, as lenders and buyers factor in both the cost of improvements and the risk of future regulations making such properties unmortgageable. Homes in areas at risk of flooding are seeing valuations impacted as insurance becomes more expensive, and climate change makes extreme weather more likely. These factors have always existed, but they're being taken more seriously now. And for sellers of older, less efficient properties in vulnerable locations, this is creating an additional hurdle on top of all the other market challenges. Making the improvements needed to address these issues requires upfront investment that many homeowners can't afford, especially when they're already facing financial pressure from other directions. This is creating a two-tier market where modern, efficient properties in safe locations hold value better, while older stock in risky areas faces a much steeper decline. The psychological impact of watching property wealth disappear is profound for many homeowners who've spent their adult lives believing their home was their most valuable asset and their retirement plan. British culture has long treated property ownership as the ultimate sign of financial security and success, and this crash is challenging those assumptions in painful ways. People who felt comfortable about their financial future because they owned a home worth several £100,000 are now confronting the reality that paper wealth can evaporate quickly, and that property isn't the guaranteed investment it was thought to be. This is especially difficult for older homeowners who are planning to downsize and use the equity to fund retirement, but are now finding their homes are worth far less than expected. The sense of security that homeownership provided is being replaced by anxiety and uncertainty, and that shift in mindset will have lasting effects on how people think about property and financial planning. For younger people watching this unfold, it's yet another reason to question whether striving for homeownership is even worthwhile when the risks seem so high and the benefits so uncertain. So where does all this leave us? The UK property market is undeniably in crisis, with valuations crashing and deals collapsing at rates that are shocking even long-time market observers. The combination of higher interest rates, economic weakness, tight lending, and negative sentiment has created a perfect storm that's leaving casualties across the country. Whether this is a temporary shock that will stabilise once conditions improve, or the beginning of a longer downturn that will fundamentally reshape the market remains unclear. What is clear is that their old certainties about property are being challenged, the human cost is mounting, and the ripple effects are spreading through the wider economy. For anyone trying to buy, sell, or simply hold on to their property in this environment, the advice from experts is to be prepared for continued volatility, to be realistic about valuations, and to understand that the market might take considerable time to find a stable footing. The era of easy gains and perpetually rising prices appears to be over, at least for now, and everyone involved in property is having to adjust to a much more uncertain and challenging reality. Make sure you stay ahead of all these developments by keeping up with Property Reporter for the latest news and analysis on what's happening in UK property and the economy.